Joining us on Wall Street Silver today is Ed Steer of Ed Steer's Gold and Silver Digest. How's it going today, Ed?
Things are great in Merritt, British Columbia today.
Awesome, awesome. Thank you so much for joining the Wall Street Silver community. First question is, global mine supply is shrinking each year while the industrial demand is growing each year. Can you envision a day, Ted, where we don't get our silver? How will Apple and Samsung respond? Will they start buying up the mines?
Well, that's a very interesting question. There's no question that silver production has certainly been decreasing year over year at a very gradual rate. And of course, the demand has been increasing more and more, especially investment demand. And industrial demand hasn't slowed down either. So at some point, those 2 points on the graph will meet. And as far as I'm concerned, if you take a look at the availability of 1,000-ounce good delivery bars, we've crossed that point already.
Mhm.
And the supply shortage is actually here now, but is not being allowed to be reflected in the price of the commodity itself. So those 2 points in the chart have already crossed, as far as I'm concerned, and where the silver is going to come from. I'm sure that the people in the Comex or J.P. Morgan, whoever supplies these large industrial users like Sony and Samsung and Tesla, whoever uses it by the millions of ounces per year, will move heaven and earth to make sure they get those bars. But there's no question about it. The squeeze is on in the physical market.
Hey, Mr. Steer, if we reach that point where industrial demand is greater than global mine supply, who doesn't get their silver in that scenario? Would it be, obviously, I think the small retail gets squeezed out of the market first. We're going to be last at the feeding trough. But who do you think, how does that play out? Have you given any thought to that?
Well, I certainly have. I worked in the retail bullion business for 4 years, so I have some insight into that market. The first thing that will show up as far as the retail trade not getting the silver bullion, the good delivery bars to fabricate into smaller bars, is the fact that lead times will go out from 1 or 2 months to 3 or 4 or 5. And then once you see those lead times start to explode out in duration, then you'll know that the physical shortage has reached the retail market and that they're cutting them off at the knees in order to provide the industrial users. That day, as far as I'm concerned, is pretty much already here.
Mhm.
But there's no question about it. When push becomes shove, the retail market will suffer the consequences, and there just won't be anything available. We've been there once on several occasions over the last 10 years, and I was involved in the retail trade at the time. So if we've been there 3 or 4 times in the last 5 or 6 years, then I can guarantee you that the time is coming again, and if it's not already here, it's going to be here again very shortly.
We saw recently even the U.S. Mint was having trouble getting silver blanks from their suppliers like Sunshine Mint or whoever else they get them from. And I mean, I almost could imagine a scenario where a lot of the private mints or even the sovereign mints, they just go out of business within the next 10 years.
Mhm.
And I know a lot of people just think that, oh, that'll never happen. That'll never happen. They'll get their silver somehow. But if you start seeing companies like Apple or Samsung or Tesla buy, they don't have to buy the entire mine. All they really need to do is buy a controlling interest or a minority stake large enough where they can ensure that they're going to get first in line for delivery, and then we're out, right? We're done at that point from a collector or investment standpoint.
Well, I suppose that's entirely possible, that the retail market could be cut off and some could shut down. We're approaching a situation that's never occurred before in the history of the silver market since it was first discovered, 10,000 years ago or whatever. So the industrial users, like pick one, whatever which one you want to use, a big one, to go out and buy, say, a mining company, like let's take Keith Neumeyer's company, First Majestic, and I know Keith very well. If they approached him to buy the mine, said, look, we'll buy your company for whatever. The thing is that the mine only produces doré bars, and other companies produce only concentrate. So the problems for Sony or Tesla, whoever, doesn't just start with buying the mine. First of all, that silver doré or the concentrate has to be shipped someplace to a refiner to get made into good delivery bars. So the process only starts with buying the mine. They would have to control the entire process through the refining stage as well. So, as to what's going to happen exactly, it's speculation on my part and everybody's part, but the day will come when something like that is going to happen. But when the industrial users have a problem, then by the time the industrial users start having a problem, then we're going to see it in the price immediately.
Yeah. Lee?
So you have some interesting take on investing in the LBMA and basically what would happen to your investment if you parked money in there overnight and what that shows. Can you go into some detail on that?
Oh, I certainly can. It's an article I sent you a couple of days ago, and what might be useful for your listeners and for your readers is when you put up my interview, is if you put the link to that article in the notes underneath so they can see it for themselves.
We definitely will.
And okay, because it's absolutely critical information. This is a speech that I gave at the Casey Research Conference in San Antonio, Texas, back in 2014. And what it showed, and it's absolutely the truth. I mean, these numbers aren't made up because I get them all from the LBMA. What it showed is if you took an investment of $100 and bought the morning gold fix in London on, I think it was January 2nd, 1973, and sold it at the afternoon gold fix in London, and then reinvested it the following morning about the morning fix. This is not including commissions. This is just a theoretical $100. That if you did that for the last 45 years in a row, that your $100 investment would be worth, I think it was $12. So what that means is basically there's a bias in the London gold fix. The morning gold fix is always, almost without exception, higher than the afternoon gold fix in London. So they're taking away whatever gains are made between the New York NYMEX, COMEX close in New York one day and the made in the overseas markets in Far East trading the next day are all taken back by the LBMA the following morning. And if it's unfortunate you can't show the chart, but the fact of the matter is that there's a definite London bias, and they're rigging the markets rather than selling physical gold into the market. They're rigging it, as you already know, in the COMEX futures market, but it's also happening in the London bullion market as well. So this has been going on, like I said, for more than 2 generations, and I don't know how old you guys are, but I would guess that's probably been going on since before some of you were even born.
Yeah. So, Mr. Steer, I saw a recent interview, it's a few months old, where you were saying you think silver's about to blow sky high. And it hasn't happened yet. Are you still of the opinion we're wound tight and about to blow sky high?
The silver market's been in this situation now for many years. And the only reason it hasn't blown sky high is the fact that the largest 4 traders and the big 8, actually it used to be the big 8, now it's concentrated in the big 4 traders. And those big 4 traders are all banks, okay? And they are, I would say, they're Citigroup, Bank America, and HSBC, which is a British bank. And those 3 banks and maybe one other are been sitting on the gold price, and it's them that decides where the price is going to go. They control almost 50% of the COMEX futures market, and until they decide that they're going to sit back and let the price rise and not come in as short sellers of last resort on every price rally, the prices are going to stay exactly where they are. But I can tell you right now that the moment they decide to put their hands in their pockets and go fishing for a couple of days and not show up to short anything, well, we're going to see silver prices and gold prices, the precious metals and all commodities in general rise to levels that you can't possibly imagine. Because ever since we went off the gold standard on August the 15th, 50 years ago next month, actually on August the 15th, there has been covert price suppression in what I call the big 6 commodities, the 4 precious metals, copper, and West Texas Intermediate. And as long as you can control the price of those commodities, you keep the rest of the commodity complex in line. So we've had commodity price suppression now for 50 years. And it's now showing up in things like lumber, copper's at a new high or pretty close to natural gas. It's way up there. Crude's over 70. But I can tell you right now with gold and silver at God knows what price, if they ever decide to let them go, I hate to think of what the price of a bushel of wheat will be at the Kansas City terminal, but it will see commodity inflation explode like you cannot possibly imagine.
Well, that leads into, the next question. I put up this chart we have, and this is, what are the short positions of silver is on here, but what other commodities, do you compare it to, and how do you sort of analyze as you referred to, the 4 largest traders or the 8 largest traders, and how they play in various commodities?
Okay, the chart's very simple. What this shows is the physical commodities that are traded in the Comex futures market. And a rough rice, which is like negligible on the left-hand side, compared to silver, which is on the right-hand side of the chart. And silver's been nailed to that side of the chart for the last 40 years. It was an odd exception. I think palladium took over for 3 weeks one time about 10 years ago when it was on a rampage. But the red, let's just take a look at silver, for instance, which is on the right-hand side of the chart. That's what everybody wants to talk about, and I'm happy to do it. The red bar represents the short position, the number of days of world production it would take to cover it. And just looking at the chart, it's about 111 days. So if 111 days of world silver production it would take to cover the short position of the big 4 traders, and the big 8 traders is the green bar. It's a big, of course, it's taller, and it's about 147 days. So the 5 through 8 largest traders are the difference between the red bar and the green bar, which is not very big. But the big 4 dominate. They dominate silver, and if you look at the red bars all the way down across the entire spectrum, they dominate just about everything. The only exception is cocoa, which is an extremely volatile product because of where it's grown and how it's grown and things like that. But other than that, you go down through palladium, soybean oil, soybean meal, copper, corn, crude oil, and wheat. The big 4 traders pretty much dominate. And in the precious metals, the big 4 traders, without exception, with no exception, are banks of one form or another. A lot of people think JP Morgan is short the market. I do not believe they are. Ted says they've been out of the market since we had that big down price spike last March, and that was them getting out of the short positions and everything they had in the Comex futures market and the precious metals. So it's the next big 8 traders and the big 4 traders are on the hook. But in the precious metals, it's just 3 or 4 banks that are sitting on the price. So for instance, you see that huge short position in silver of 147 days by the big 8 traders. And you go down to crude oil, which is the third one from the left, on the far left, and there's about 4 days that the big 4 are short, and about 6 days that the big 8 are short.
Yeah.
Just imagine what the price of crude oil would be if you took the short position of 147 days of silver and stuck it on the price of crude oil. Well, it would be about $5 a barrel. And so just to give you some idea of just how badly silver, platinum, gold, and palladium are suppressed, I can imagine the silver price well into the 3 digits if that short position wasn't there. And I mean well into the 3 digits.
Yeah, somehow I think that the Saudis or OPEC would not allow a short position like that in crude oil.
Absolutely not. Absolutely not. They would be screaming bloody murder, and whoever had that short position would be either dead or in jail.
Yeah, they wouldn't be able to travel outside of their personal private security guards. They'd be taken out somewhere. But
even that wouldn't help them. Okay, let's put it, oil is the lifeblood of the entire world's economy, and there's no way on God's green earth that the CFTC, the SEC, or anybody in the U.S. government or military-industrial complex would allow that to happen.
So Ed, we're looking at a chart of Campbell Soup. It's pretty much been exactly the same product for well over 100 years, and this is a chart showing the price. And you could see the price was very, very stable up until the early 1970s when we went off the gold standard. And from that time, it's pretty much shot almost straight up, which would you agree that is pretty much what a precious metals chart should look like?
Oh, exactly. There's no question about it. And you can take any commodity, I don't care what the heck it is. Back in 1971, and I don't think any of you guys were around then, but I remember that time period well, because I remember the hoot and hollering that was going on in our small town in Manitoba in Canada, where I grew up, when the silver disappeared out of our currency back in 1967 and 68. There was a national currency shortage as all the older people at that time rushed to take all the dimes, quarters, 50-cent pieces, and silver dollars that they could get out of circulation, because of they knew that silver was valuable. And then starting shortly after that in 1971, when we went off the gold standard, I remember the jumping up and down at the post office when the price of mailing a letter in Canada went from 5 cents to 6 cents. And then 3 months later went to 7 cents. Well, man, it was almost a national insurrection when that happened.
Mm-hmm.
But when I was a kid, you could mail a first class letter to anywhere in Canada for a nickel. Okay. And our dollar was worth the same as the US dollar back then. Now, for me to mail a letter to somebody here in Canada, it's $1.20.
Wow.
So I don't know what that translates into, but it's about 1,500 or 1,600%. So if you took silver and gold and precious metals and let them appreciate the same way along the sides of the rest of the commodity group, whether it be stamps or whether it be cans of Campbell soup, everybody would be in commodities right now, because they would be roaring higher. But because they've been actively suppressed through the suppression of the precious metals and copper, that's never been allowed to happen. So you can't see it. It is inflation, but it is inflation not as we know it. So they're desperately trying to get out of this. And so that's why the gold chart and the silver charts look the way they are compared to the price of a can of Campbell soup since 1971.
So what is, you say they're trying to get out of this. Do you think the powers that be want silver and gold to go up now? Or, I mean, help me understand what you're just saying there. Or they're trying to get out of the price suppression? Is that what you're saying? Or
yeah, the end is coming, and I've been watching what they've been doing. It's hard when you're standing on the ship, looking at the deck, and all of a sudden you look up and you look around and say, "What's happening?" But the further you get away from, further you would get past the point of where things have started to change, the more you realize what they're trying to do. They want precious metals prices to rise. And if you take a look at the amount of silver and gold and they've been going into these ETFs and mutual funds, not just since you guys showed up in the scene, God bless you all, but the last 3 or 4 or 5 or 6 years, you go back to the charts that Nick Laird puts out on the exchange traded funds and the mutual funds that have been collecting gold and silver. It has really taken off in the last 4 or 5 years and really spiked up last year. And it's not all John Q. Public that's going into these things. There's big, big, big money going into these funds, huge amounts of money. And it's my opinion that the people that are buying these things, that are squirreling this stuff away, are the players that are actively involved in trying to end this price. Like I'm talking about the people with the billions and hundreds of billions to spend, that they know what's coming and they've been squirreling this stuff away for the last 3 or 4 years, and they're well prepared for it. And one of these days, whatever day they choose to decide to let this thing go, they actively want commodity prices higher. They want this thing to end, and it will, but we just don't know what day that's going to be.
it'll be when they have enough, or they've bought they've used all the cheap money they can to buy the hard assets.
Pretty much. That's pretty much they're running the equity markets and the bond markets hard as they can right now with all the paper money and buying up everything of value that they can before they pull the pin on this thing.
Yeah.
And someday, either by design or circumstance, the whole thing's going to come crashing down, and the only thing left will be the precious metals and commodities.
Well, that's a big question as to, how do the central banks respond here? A lot of people, we've heard, they're in a debt trap, right? There's too much debt for them to raise rates. They can't taper. They can't stop buying, whether it's, the European Central Bank or the Federal Reserve. They can't stop buying bonds. They can't raise interest rates at all. There's simply too much debt out there. There's no playbook that they have other than jawboning the market with their statements right now. And, how do they get out of this? Have you given any thought to that, or is it just print, like, and there's just no other playbook out there?
It's, we've all heard the expression print or die, and it's become print and die. There's no way out for them now. They know that what they're doing deliberately. They intend for the financial system as we know it, as we've known it all of our adult lives, and my adult life has been longer than yours, is that the system, once you go off a gold standard, no fiat currency system in the world, and I don't care whether it's the US dollar, British pound, euro, the ruble, the yuan, the yen, whatever currency you want to pick, has ever survived without a gold backing to it. You look at all of recorded history. This has been talked about by me and everybody else that's involved in the money game for the last 20 years. They know that the system will not survive. The central bankers are well aware of that, and they're going to bring an end to it. And they're going to bring in their own currency, whether it be in a digital form or the special drawing rights that the IMF has. The IMF is the only central bank out there, quote unquote, the bank of all banks. The central bank's bank has a clean balance sheet, and they're already talking about issuing another $650 billion worth of these special drawing rights. And that could become the new world currencies. And of course, our currencies will still continue to exist, but they'll be extremely devalued, A, against these special drawing rights, and B, against precious metals. The banks know perfectly well this is going to end, and I wouldn't be surprised at all if Jerome Powell and all these guys, Mark Carney, and all these guys that are poo-pooing gold and printing money hand over fist are one of the largest shareholders of all these ETFs and mutual funds. These guys got themselves covered 7 ways to heaven, and when they pull the plug, they'll be the only people left standing. Anybody that's got precious metals will be the only ones left standing, so we got to become our own central banks. And that's what your Wall Street silver crew have become, as their own central banks, and the more power to them.
Ed, there's PSLV and there's retail right now that seem to be dominating the story. I'm going to share a screen with you here. And are you seeing this impact in the 1,000-ounce bar market? This is, showing how PSLV's inventory has been vacuuming up all the 1,000-ounce bars in North America. At the same time, Comex inventory has been declining since February of this year. What are you seeing in your own research?
I'll tell you what, Ted Butler is the real expert on this. He has made the comment already that the rapid increase in PSLV is almost a mirror image of what's happening in the Comex. And he figures that the silver that's been feeding into PSLV and other ETFs is coming out of the Comex. There's a finite amount of this, but I'll tell you what, the Wall Street Reddit silver crowd, when they first showed up on the scene, took the world by absolute storm, and nobody, and I mean nobody, not the big shorts, not the CFTC, not the SEC, was prepared for the onslaught that followed, and it's just absolutely jaw-dropping ever since. So these are directly correlated. One is feeding the other. There's no question about it at all, and I'll tell you what, it's 100% due to you guys, and the more power to you and to all your apes out there, and I'm one of you.
Yeah. Well,
and proud to be, by the way, proud to be.
Well, thank you. Rick Rule said something similar. He said when he first saw Wall Street Silver and the Reddit crowd come on the scene, he thought it'd be a very short-term thing and nothing would happen. And he said himself, he was shocked at how much silver has been taken off the market by the retail crowd, in combination with what PSLV's been doing, vacuuming up all the 1,000-ounce bars. And I sort of view it as a two-pronged strategy. Take out the 1,000-ounce bars, and retail keep vacuuming up everything that we can as the small investors, and maybe combined. I don't know where the breaking point is in Comex registered inventory. Maybe when it falls below 100 million or 80 million, who knows? But at some point, doesn't the leverage just get so out of control? There's not enough physical there, and their number of paper contracts per ounce is just
okay. Well, here's the thing. Okay, there's always the physical there, and it's about 50 miles high and 100 miles across. The seller must be willing to sell to the buyer at the current price, And at some point, you're going to reach a point in the supply demand curve where the buyer reaches out and says, I want to buy the silver at the current spot price. And the seller says, I don't think so. Okay. And sooner or later, we're going to arrive at that point. And when it does happen, they're going to see the price get bid up in a hurry. It's going to go from whatever it is today. You're going to be looking up, it's going to be up like $1.25. And unless the short sellers of last resort show up, the price is going to get bid up until somebody's prepared to part with it. You won't have to ask what day that arrives, because you'll just be able to look at the chart and say, okay, today's the day. Okay. But until the four short sellers, the big four shorts, decide to get off the selling short the silver market, and until the real shortage hits, which I consider to be here already. It's just the fact that they're sitting on the price in the paper market. Because if they weren't right now, you'd see silver at 10 times the price it is today. And we will all live to see that day, because it is coming.
And do you have any thoughts on the pooled accounts and their influence on the price? I mean, are they kind of like an artificial short position as well, like diluting the market?
Your pool accounts, and you're talking pool accounts, you said?
Yes, pooled accounts.
Oh,
Allocated,
okay.
unallocated.
Oh, unallocated and then pool accounts. Yeah, okay, fine. Look, I consider them to be the biggest fraud out there. Mm-hmm. And I wouldn't have a nickel in those things. A bird in hand is worth two in bush. And I can tell you right now that if I guess the Perth Mint and Kitco would be the two biggest purveyors of that product. And if a large, let's say the price jumps up to $100, okay, just for fun, and all of a sudden 3/4 of the people at Kitco and the Perth Mint decide, okay, fine, either A, I want my physical silver, or B, I want to sell. I mean, all of a sudden, they're going to be looking at liabilities in the billions of dollars. They're going to have to pay out either cash or get the physical silver. And I don't think either firm will be able to survive that. In my opinion is, if you own money in these, either convert now, sell, or going to go buy the physical silver, because when the supply crunch comes, a bird in hand will be worth two in the bush, because you won't be able to buy physical silver at any price at any retail store.
Mm-hmm. Rob Keats and another auditor, Daniel, I forget his last name, they just, about a few weeks ago, they had these are two auditors, and they walked through the Perth Mint's audited financials, and they clearly pointed out the Perth Mint is short about $1 billion worth of, if the Perth Mint's at real risk of being a going concern with their current balance sheet.
I've seen that, and I'll comment on it right now. It's probably correct. I took advanced management accounting in Alberta, so I know something about the balance sheet, and it's probably true. But if you think it's bad now, let me tell you how bad it's going to be when silver's pushing $150 to $200 US an ounce, and people are screaming A, for their money, or B, for their silver. Well, I wish them luck.
Well, those programs, it was described to me, it's basically a gift card from Kitco Metals or Perth Mint. You're giving them your money to fund their inventory, and you've basically got a gift card. Maybe you get some silver in the future.
That's why I say sell it now and go out and buy the real stuff, man. Like I said, it's paper versus physical, and when the crunch really comes, you won't be able to buy physical at any price for years, if not decades to come.
Yeah, especially if the mines keep their current trajectory of producing a little bit less every year. I just can't help but see that this breaks at some point in the coming 5 years. Hopefully.
Oh, 5 years! I would be surprised if anything lasts another 5 months.
Yeah. Well, Ed, this has been great. I'd love having you on our show. This has been really fascinating to listen to, and we definitely want to have you back. And we're going to take up a collection to get you a laptop, so you have a better webcam, so we can talk to you face to face next time. You're going to become our new, we're going to do a GoFundMe, buy a webcam for Ed. And,
no, I promise I'll buy a new screen, and I can't afford it, so I will do it. So anyway, my congratulations and salutes to all you apes out there, because I'll tell you what, if you think that the little person can't make a difference, they certainly can. You have, and you certainly will continue into the future, because it's the purchasing that goes on at the margin. And when you guys showed up, I mean, everybody woke up. And the fact that you've been on CNBC so many times and have so much television time over this tells me that, man, you've made the biggest possible impact, and just keep on trucking. And I wish you all the luck in the world. Go get them.
Thank you, sir.
Thank you.
Thank you so much, Ed.